1.5 million Americans are projected to be out of a job if the U.S. has a short-term default on its debt. That would happen within just 1 week of breaching the ceiling.
Right now, the U.S. is on track to run out of credit June 1st unless a deal is reached between the president and Republican congressional leaders. In the event of even a short-term default, every state in the country would see some level of job losses. The highest number of cuts are projected to be in Missouri, Pennsylvania, Ohio, Illinois, and California.
Irina Ivanova is here with us now. She's the associate managing editor of CBS's MoneyWatch. Irina, welcome. So let's look at specifics here. When we talk about the effects, which jobs and industries are most at risk here?
Sure, there's sort of levels of fallout here. So Washington, D.C. is obviously ground zero for this. About 1 in 4 jobs in that region are connected to the federal government. Then you see states with military bases, national labs and national parks, forests, so places like Alaska, Hawaii, which is home to the U.S. Pacific Fleet, and New Mexico, which is home to Los Alamos National Laboratory. And then there's the companies that support the federal government or do a lot of business with it. So defense contractors would be very heavily impacted. Those are concentrated in Connecticut, Kansas, and Washington State. And then professional services firms, which sort of support the office functions of the government. And those are largely in Northern Virginia.
And then, so that's the first level. But then obviously there are going to be ramifications that ripple on through. What happens next then?
Absolutely. So the trickle down is almost certainly recession. And this is a little speculative because, of course, we don't know what the government would decide if it can't make all of its payments. But just think about all the people who get money from the government. So you're talking about potentially Social Security payments not coming through, healthcare facilities not getting Medicare or Medicaid payments, anyone getting unemployment income, anyone getting SNAP food benefits. This is lots of people not getting money that they're owed. And then, of course, the federal employees who may be showing up to work with no guarantee of a paycheck. Long term, think about businesses that are very sensitive to economic swings. They would be most heavily hit. So manufacturing is what's called a very cyclical industry. You would see states like Michigan, South Carolina, Tennessee, Kentucky disproportionately impacted in terms of employment, and places that rely on travel too. So Nevada, Florida, Arizona.
What about timeframes here? How does the prognosis differ for a short breach versus a prolonged default?
It's sort of the difference between really bad and unfathomably devastating.
Oh, gosh.
So even short to put it in non-economic terms. But so Moody's Analytics estimates that even a short breach, and we're talking, less than a week, a loss of about 1.5 million jobs nationwide, and the unemployment rate jumps from where it is now, which is about 3.5% to nearly 5%. Of course, a jump of unemployment of that magnitude, that immediately means a recession. Now, in a prolonged breach, which goes on for longer than a week, in the worst case scenario, we have nearly 8 million jobs lost. And the largest states see the biggest losses because of population, but a lot of the harshest impact is actually in smaller states where they may have a smaller population, they may have a less diverse sort of economic base, they may be more dependent on federal spending. A lot of these places will see a 5% drop or more in employment. More than half of the states will see a 5% drop in employment. And that's, we're talking 1 in every 20 people losing their jobs.
Wow. And Irina, I know last time we were sort of in this negotiating phase, that there were impacts even without hitting the debt limit, the downgrade to the U.S. credit, the financial impacts that happened because of that. We already see the stock market being a bit scared about what's happening in Washington. What are some of the impacts that continue to accrue as we get closer to the deadline?
It's really kind of a risky game because we don't know what the financial markets are going to do. But, we can look at what happened earlier last year when there was this giant swoon in the stock market. We saw trillions of dollars in wealth in people's 401k accounts just wiped out. So,
trillions of dollars wiped out.
I think
people's 401ks.
Roughly 3 trillion was the estimate. So we can say the market is not real money because it's just sort of, investors' feelings and how they feel about what's going to happen. But it is real money.
If you're counting on your 401k for retirement and it's wiped out, that's a real impact for you. All right, Irina, thank you so much.
Thanks for having me.